All right. Good morning, everybody. Thank you for that. I've got to shorten my bio. That's quite a bit to listen to. I've been around, thumping around Dallas for quite a while now. In fact, I was a graduate of a former MetroTex leadership class. I'm trying to remember what year it was. That I'll give you an idea of how old I am. It's hard to remember. But for the last 10 years, I've been working for IPX Investment Property Exchange Services, offering qualified intermediary services, not only locally, but nationally. So IPX is a national company where our parent company is FNPG, Fidelity National Title Group, and that they are a parent company to Fidelity, Chicago, Lawyers Title. If you look at all the title operations in the country, Fidelity National Title Group runs, anywhere from half to a little bit over half at any given time. And so through that association, we're able to provide the highest insurances in our industry for our customers. And that is very important because the type of transactions that we do can vary in size from just I think the smallest transaction I've ever done is probably a $30,000 rent house. And what we've gone as high as about $2 billion in oil and gas royalties. So there's a broad selection of property types that you can 1031 exchange as long as they meet the eligibility criteria, which is primarily that they be held for investment or productive use in a trade or business. Right here is just a little bit more about IPX and me. So over the last 10 years, done over 10,000 exchanges, average about 1,000 a year, maybe a little over that.
Again, Patrick, your screen share is not showing up.
Oh, do you see the PowerPoint? Or no?
No, I do not see your screen share.
Okay, let me try this again.
There we go. And now if you put it in presentation mode, it'll work great.
Great, we will do that. Let's see.
Down at the bottom, that little
yeah, there's a little thing in front of me. There we go. Ta-da. How's that?
There you go.
Awesome. All right. So this is just a little bit more, and I'm going to be sending this PowerPoint to all the attendees here should you want it. I can get a list from Steve, I'm sure, and email these out. So just a little bit more about IPX. We offer $100 million fidelity bond profile, $30 million errors and omissions policy, and then we have a $50 million performance guarantee, which is important when you're considering who you're choosing for a QI. You don't want to go with somebody that is not prepared to be able to cover your funds. Security of funds is a really important part of what we do, and we have a lot of things that we do to prevent anybody's monies from being at risk. So we're going to put this one aside for now. So let's talk about some basic 1031 rules. This is, this seems simple when you look at these four issues, but when you're talking to people, it's often something that bears repeating. Because there's so many different misconceptions about 1031. Now, basically, and it can be counterintuitive, these four things have to be done to achieve 100% tax deferral, which is what most people are trying to do. So in order to achieve that, you have to do these four things: buy equal or greater to the sales price of the property that you're selling, right? Minus real estate commission and title insurance premium. So let's say you sell for $100,000 and you had $10,000 of real estate commission and title insurance premium, then your target to go buy is $90,000. The second thing you have to do is reinvest all the equity or cash proceeds you receive from the sale in new investment property. That could be one or multiple. And then the third is replace the value of the debt. So if you have a loan on the property you're selling, you have to go get an equal or greater loan on the property or properties you buy. And then the last one is you receive nothing in the exchange but like-kind property. Now that's another kind of common misconception about 1031 property is that if I sell an office building, I have to go buy an office building, or if I sell a rent house, I have to go buy a rent house. But in reality, you can sell a rent house and buy an office building, land, retail, office, industrial, warehouse, royalty interests in gas and oil. So there's all kind of different types of properties that you can purchase with your 1031, going from one category to the other, selling one, buying multiple, and selling multiple and buying one. Excuse me, I've got an Irish setter who's trying to join the program. Come on there, guy. And so if anybody has any questions about that, I'd be glad to take them, because there's often the misconception that you only have to reinvest the equity portion or the cash that you receive or your profit, and that you can pull parts of that the equity out, when in reality, if you could do some of those things, but you'll create what's called BOOT, or taxable income, in your 1031. And so it's in a lot of cases, people are going to do that knowingly. They're going to be like, okay, I want to pull some cash out of my exchange to go pay off bills or go buy a boat or take a vacation. Completely fine. The important thing is, you know, that any cash that you take out of your 1031 is going to be taxable. So going on to the next topic with 1031, this is kind of, you know, the way we go, this is set up, it's kind of how you're confronting these rules and things as you go through an exchange. So the first set of rules that people have to confront in actually doing their exchange are the identification rules. So there's 3 identification rules with 1031 exchange. And the first one is the 3 property rule. And the 3 property rule says I can identify up to 3 properties of any value. So that means regardless of what I sell my property for, I could go out and I can identify 3 properties, and their combined value could be, you know, $100, $1 million, $1 billion. It doesn't matter, as long as you're identifying 3 properties or less. Now, the second rule is the 200% rule. And it says, if I identify more than 3 properties, it can still be okay as long as the combined value of the properties is not more than 200% of what I sold my property for. Or so when I'm looking at this rule, I would say, let's say, same example, I sell for $100,000 and I go out and I identify 4 or 10 properties. That's okay as long as the combined value of my properties is not more than $200,000. So you can see where that could be limiting if you're selling a low value property, but it opens up some doors if you're selling a high value property. The last one is the 95% exception, and that's not really relied on very often. It's only used in special circumstances. And what it says is, if I surpass the 3 property rule and the 200% rule, I could still have a valid exchange if I successfully close on 95% or more of the properties I identify. Okay, so you wouldn't want to do that if you're going under contract on, let's say, 4 or 5 properties with different sellers, because chances are one of those is going to fall. And then you can't really rely on that, or you cannot rely on that identification rule. Where it would work is, let's say you sell a warehouse with 1 address and you sell it for $1 million, and then you go out and you identify a warehouse complex and it's $5 million. Okay, you know now that you've identified more than 3 properties, so you've got the 200% rule to contend with, and the value is more than the 95 or more than twice what you sold for. But you're going to close on the whole thing or nothing at all. You're going to buy the entire 5 properties in the complex, or you're not going to buy anything. So that's where you rely on that rule. Not often, but it's there for special circumstances. Okay, so qualified properties for 1031. Like I said, there's like all kind of different properties you can buy and sell with 1031. Okay, retail, office, industrial, warehouse, rent houses, residential, land, farm and ranch, all kind of different things that can be exchanged freely with each other. But the qualified purpose of the land is, I mean, the qualified purpose of the property is very important. So it's held for use in a trade or business or for investment. So not held for sale. So inventory or flips. Um, let's say if you take a look at Toll Brothers or David Weekley Homes or Lennar, they may have thousands of properties that they sell every year, but they don't exchange them because the IRS doesn't consider them eligible. So they don't meet the test because their intention is resale and not for held for investment or productive use in a trade or business. And there's also a lot of emphasis put on the intention when you buy a property. Is the property going to be, is your intention to resell it, maybe fix it up, flip it and sell it, or is it to rent it out? Well, the latter is okay, the former, the latter is okay, the former is not. Let's see, I've got some questions. Those are not for me. All right, great. So then, the next part of the qualified purpose is not held for personal use. So no primary residences or second homes. Now, there is a way to convert a property that you buy with 1031 from an investment property to a personal use property. And I'm going to get to that towards the end of the to the end of the presentation. It's pretty neat. And the test is at the time of exchange. So when you're doing your exchange, if your intention is to go buy a property and rent it out or use it for a business, or if it's acreage, you're going to run cattle on it or grow hay, that would be a qualified use. If your intention is to turn around and sell it, then it's not qualified under the qualified purpose test. And part of that, aside from the intention, that also goes towards the determination by the IRS is how long you've held it. Now, there's so many things with the IRS that are gray areas, right? And this is one of them. The IRS has never put forth a bright line time period that you have to hold a property so that it's eligible for 1031 without question. However, what we've seen historically is if you hold a property for 2 years or longer, you eliminate risk of being challenged by the IRS, provided your intention is in line to be held for investment or productive use in a trade or business. So if you look at it from making a decision on when to sell a property, it may be 2 years, you've got no issues. Under 2 years, but over a year, you've got very little issue if your intention is to, hold it for appreciation or for productive use in a trade or business. If you hold it for under a year and sell it, now you're getting into a little bit more risky area because 1031 exchange is designed to defer a long-term capital gain tax, which only occurs after you've held the property for over a year. If you sell a property in under a year, now you're looking at short-term or ordinary income is the way your sale would be treated. Far higher tax rate, and if you can hold a property, I get people that call me all the time. Hey, I just got an offer for my property. I've only held it for 10 months. I'll say just if you can, to make yourself a little bit more confident in your 1031, you may want to put your closing off for a couple of months so that you're not under that 1 year time frame, because I think that could be a red flag for the IRS, where they say, they're going to see the tax return, they're going to see possibly that it was done in the same year or the previous year, and go, okay, what's the story here? What was your intention? So it may be escalated, and they may, add some questions about, okay, what was your intention when you bought it, and what changed in that? Why did you sell sooner? Let's see. I've got a question here from Robbie. We could sell an office building for $2 million and buy a $1 million shopping strip and 2.5 residential properties for rental income. Absolutely, yeah. So you could combine the types of property you buy. If you're also talking about the amount to get to 100% tax deferral, you still have to get to that $2 million sales price of your office building. Okay, so, and that's in aggregate, right? So if you're counting all the properties together and you get to your target replacement value, that's perfectly fine. All right, let's move on. What's like kind property? This is kind of a mantra. Retail, apartments, single family, raw land, industrial property, commercial, percentage of interest in a tick. It's also farm and ranch, which I've been doing a lot of them last year because farm and ranch is just receiving unbelievable offers. And 1031 can really be helpful for these people because, you know, they may be very land rich, but cash poor. So paying the tax liability on the sale of their ranch, you know, when people are seeing 20 to $30 million being offered for their ranch property, it could be problematic, right? If they don't have the cash to pay for the taxes and they're not advised properly, it takes the thrill out of selling a $20 million property. This percentage of interest as a tick is important to note too. A lot of times I'll have people that want to sell, let's say they're in a partnership or they're a single person or a married couple, but they want to go buy property with other people, or they may want to buy into a large commercial project, and people will be offering to sell them shares or partnership interests in the entity that owns the property, which is not allowed with 1031 exchange without doing some lawyering to turn it into a tenancy in common interest. It doesn't work with 1031, and the reason being is if you look at it from just a common sense standpoint, if I'm a taxpayer and I go and I sell as, you know, Patrick, and then I try to go buy as limited partnership A, well, my benefit doesn't align up to me, right? So that doesn't work. Shares don't work either. If you wanted to go buy interest in a REIT or something like that, you'd be dead in the water. However, the REIT situation can be, there's a reasonable facsimile to a REIT called a DST or Delaware Statutory Trust. And these are popular with folks that are retiring and don't really want to be a property manager anymore, or don't specifically want to go out and get new debt to the amount that they need to achieve 100% tax deferral. So they may invest in these DSTs, and they're similar to a REIT in that you're buying interest in a more institutional grade piece of property. However, you're actually going to buy a fractional interest in that property, the way these are set up, and so that you are not buying shares like you buy when you buy REIT interests. They're, you know, at first I was skeptical when I first ran across these 10 years ago, and I just kind of was a wait and see. But what I've seen over the years is the people that invest in them seem to be happy with them because they just roll them over, right? Whenever there's a liquidation event of one of these institutional grade properties, these folks take part in any profit if it's there, and then they can roll over into another DST, or they can go back into more conventional real estate if that sounds like something, or if that's something they prefer. So that's just another option. And the cool thing about that too is if you don't want to go out and get a new loan, let's say you sell a building and it's got a $500,000 loan on it, and you got $500,000 of cash coming in. Well, with a DST, you use your $500,000 of cash, and they've got the debt component built in, so you don't have to go out and qualify for a new loan, which is pretty nice. Okay, some of the more unusual types of exchanges that happen are leases with at least 30 years remaining, including renewal options. These don't happen as commonly as, you know, just regular purchase and sale, but they do occur. So they are eligible. The important thing is they do have that 30 years remaining, and that includes the option. So it could be, you know, their initial leases for 10 years and they've got 5 10-year options to renew. That'll work. Cell phone towers and perpetual easements, those are more common than the leases. And an undivided interest in one property for a 100% interest in another property, i.e. tenants in common, where each has an equal right to possess the whole. So that's very common. That happens all the time. I heard a click. Does somebody would need to ask a question? Nope. Okay. a remainder in interest in property, and timber rights, riparian rights, mineral rights, and development rights can also be purchased with 1031 exchange. So, but that is very rare. I have, even with all the farm and ranch I do, that hardly ever happens. With a few exceptions in exchange. So the taxpayer requirement, it gets back to what I was saying earlier. The taxpayer that sells should also be the taxpayer that buys. So, and the taxpayer could be a number of different entities. It could be a partnership, or individual, or corporation, but they all have to buy as they sold. So I've got a quick question here. If I have an investment property in another state and I want to invest proceeds here, how could that take place? FHA loan involved. As far as we're concerned, you can exchange freely all over the country. The exception being Puerto Rico. And in some states, you want to be cautious that they recognize 1031 on a state level. Pennsylvania used to not, but they've turned around their law, and now they do recognize 1031 exchange. If you go to some states, they have clawback taxes, so you want to be aware of that. So let's say you sell a property in California and you want to move to Texas, which is happening every day, as you can imagine. There is a clawback tax that actually California has that requires that you file a status report on the property you buy with your 1031 in perpetuity. So the California Franchise Tax Board is very aggressive about getting that tax. If you don't file that if you don't file that status, they're going to try and collect the tax immediately. So it's important that you're aware of that, your CPA is aware of that, so that they kind of, well, they definitely are filing that along with your income tax every year. And if you don't do a 1031 exchange, you're going to be paying that. It's 13.8, I think, percent California capital gain tax on the sale of investment real estate. There's a few other states, maybe 6 or 7 others that have that. All right, same taxpayer requirement. Why aren't you turning? There you go. All right. So again, this goes into length of ownership. I think we've covered this enough already, but 1 year, over a year is good. 2 years related party is okay. Related party transactions, I would suggest if you're selling to a related party, not an issue. If you're buying from a related party, it can be very problematic. And so if you've got somebody that says, hey, I'm going to sell my hotel and buy my brother's hotel, or I'm going to sell my ranch and buy my brother's ranch, send them to a QI quickly, because there's additional steps that have to be taken in a related party exchange to make sure that it is eligible. It's kind of an arm's length transaction thing that the IRS really doesn't like to see. So they've created these extra hoops that you have to jump through. Typically, it's going to be that the related party also successfully completes an exchange for both exchanges to be valid. Then the conservative, if you're me and you don't want to talk to the IRS under any circumstances unless absolutely necessary, you're conservative, you want to wait 2 years or more before selling a property and entering into an exchange, or buying a property after you buy a property and then reselling. 2 years is the best way to go to eliminate that risk, and that's the route I take. Let's see, exchange vesting issues. So grantor trusts, like a revocable living trust, if the trust is disregarded for tax purposes, property can be acquired by the trust or by the trustee in his or her representative capacity. That's pretty common. Death of exchanger is not very common, but it is through the way the 1031s are set up. The estate can complete the exchange on behalf of the exchanger. I've had maybe 2 of those in 10 years, and it's pretty straightforward. It gets handled. Single asset entities, an exchanger who relinquishes an individual can acquire replacement property in a single member LLC. This entity is generally disregarded for tax purposes. and provides, and Revenue Procedure 2002-69 provides that a husband and wife owned LLC in a community property state like Texas can choose to be a disregarded entity. So that's very common. I'll have not only, you know, a single person or a married couple that will form a disregarded LLC to buy their property, but also like a limited partnership. I've got a company that does restaurants all over the country. They own thousands of them, and every one of those restaurants has a single member disregarded entity as the owner for the purpose of the purchase, with the same taxpayer LP limited partnership as the single member of all of those LLCs. And they do it for a number of reasons. One would be accounting separation, so they can easily see this Buffalo Wild Wings number 20 as opposed to this Red Robin number 10 in Des Moines. Aside from that, they get additional, there's some protection in terms of insurance and liability issue. Guy slips and falls in Buffalo Wild Wings, and it's in a single member DRE. Technically, he can only go after that Buffalo Wild Wings and not the Red Robin in Des Moines. So those are really important and really frequently used. It's sometimes it's not a requirement, but sometimes people think they are required to form an LLC. That's not true. If you sell as a single person or a married couple, you can go buy as a single person or a married couple, or if you sell as a limited partnership, you can buy as a limited partnership. But some people want to do these for those separation purposes. Corporation merges out of existence. Now, this is something, corporations that have shareholders, that is very difficult to do any kind of a split on a 1031 exchange. It takes years to be done properly. So in most cases, those corporations are not going to do an exchange, or if they're going to do an exchange, it's going to be the corporation that is the seller is going to buy the same. So most corporations understand that. Their attorneys and their CPAs are going to advise them of that. So don't get a lot of people that come in as a corporation and want to exchange without having consulted their attorney and understand that it's very kind of time, it takes a lot of time to do. Okay, another question here. Hi, Patrick. Client wants to sell the business only and wants to use 1031. Can a client buy a similar type of business or use exchange to buy real estate? If you're talking about selling business assets, in tax reform done in 2017, they eliminated the ability for people to sell or exchange, business assets. The only thing that you can exchange now is real estate. So the business aspects can't be sold and then exchanged into real estate. It can't be sold and exchanged into real estate. If there's a real estate component to the business, they can exchange that, but they can't sell business. Like, you can't sell and exchange goodwill or inventory or licenses or any of that stuff anymore. It all went the way of the dodo in January 1, 2018, which is, one of the reasons why we're so active in trying to prevent change or limitation on 1031 exchange. It's usually under threat around any kind of election, because politicians, without realizing how important it is to our industry in terms of being a lubricant to keep it moving, always they want to get the headline saying we can grab all this tax at this one time. And, it sounds good to people that don't really understand what it accomplishes, which is a more smooth running real estate industry where people are paying taxes on property. So I'll get on that. I won't want to do much on that. When you get my email, it's going to have a link that you just click on. It maybe takes 30 seconds, and it sends an email that says, you're a real estate professional and you'd like to make sure that 1031 goes unscathed. Please elaborate. Another question. Sorry. Please elaborate the difference between like kind and qualified properties. Well, they're very similar. Like kind, I would say, is more general in terms of it's real estate, right? It's real estate that's held for investment or productive use in a trade or business. Qualified properties go into more detail at what makes it like kind. So like kind general, you can sell land, retail, office, industrial, RV parks, mini storages, all these different types. The qualified properties are also meet the criteria that it's been held for investment or productive use or to trade a business. That was the intention when you bought it, and it's been held for at least a year. I mean, again, no bright line time period, but the qualified properties go towards what makes it qualified. I'd say like kind is just a general real estate held for investment or productive use in a trade or business. Some of the motives that people have when doing an exchange, and I always say they're not motives to do an exchange, they're a motive that works alongside of an exchange, right? So if I'm going to sell my property to increase cash flow, well, it makes sense to go with a 1031 exchange. I'm going to sell a property that I've held for investment. I'm going to go buy a property that I'm going to hold for investment, or maybe a couple, so that I increase my cash flow, right? Works well together. Depreciation. This is it's becoming more common as older people are getting out of the investment property, and they've depreciated properties that they've held for 20 years or more, right? They've depreciated them every year. They take their depreciation to adjust their ordinary income so that they don't pay as much tax. They depreciate it down completely after a period of time. Could be 20 years, could be 30 years. If they are taking accelerated depreciation in the form of a oh gosh, what are those called? When you break down the aspects of a property and you accelerate depreciation on some of them, like air conditioning or roofs, and so that you're taking more depreciation quickly. Cost segregation. Cost segregation properties are really going to be more desirous to do a 1031 exchange because they've taken so much depreciation that their basis, the tax basis in their property, is very low. And that means that they have a higher tax liability. All the depreciation you take over the years is taxed at 25%. Whereas with the gain, realized gain, you're taxed anywhere from 15 to 20% on a federal level, potentially an additional 3.8% for wealthy taxpayers. That depreciation, it doesn't go away. The IRS is going to collect that in that 25% on what you've taken over the time. But if you do a 1031 exchange, you're exchanging that as well as the appreciation, the realized gain. So you're exchanging all of it by reinvesting in property of equal or greater value that's also held for investment or productive use in the trade or business. Appreciation, so you've got a property that's in a slow market, you're ready to get rid of it and move into a higher valued area or an increasing in value area. That's another reason people, I think it's which comes first, the horse or the carriage. Usually it's going to be that motivation, and then they go, okay, I'm going to do a 1031 to also defer the tax. Conversion, acquire property suitable for future conversion to a primary residence or vacation home. Now this is really cool. So there's a revenue procedure that accompanies the company's 1031 exchange. It's 2008-16, and it says if I buy a property with 1031 exchange funds, and I initially invest, I treat it as an investment property. And this is going to do mostly with residential. So I'm going to go out and I'm going to buy a lake house, someplace, or beach house in Malibu, whatever. And I'm going to exchange into it using a bunch of properties that I've been exchanging for a while, right? So it could be my last investment move, right? So let's say I sell all the property that I've been exchanging over time, and I buy my dream home and I'm going to live there for the rest of my life. Well, you use this 2008-16 that just says basically that you will rent the house out at fair market rent at least 14 days per 12-month period for the 2 12-month periods following the acquisition. And then you'll also not utilize it more than 14 days or 10% of the time that you have it rented out at fair market rent per 12-month period. Now, if you follow those rules and let your CPA know and declare that income on your income tax, and that's your reliance on that revenue procedure, after those 2 12-month periods have elapsed, you can move into that property, and the IRS can't make you pay the taxes back that you deferred it to get into it, right? It's like a get out of jail free card. So if you have let's say you've built up, $5 million or $10 million in tax and all the investment property that you've been exchanging over the years and you buy, $10 million house, that all that tax goes, well, if you buy equal to great to the combined value of the properties you sold, you're going to have no tax liability on them, and then it could go away if you stay in that property forever. Now, for some people, that's great. For some people, they go, well, what if I have to move? Well, then you've got a choice to make. You could either requalify the property as an investment property by putting it out in the rent market, or you could, maybe take your primary residence exclusion of capital gain if it's sufficient enough to defer enough tax that you're okay with it, right? Your exclusion of capital gain for a single person is $250,000. For a married couple, it's $500,000. But that's a really great, I think, end of your investment career move to really save. Let's say you sell a ranch for $10 million and you go out and buy a rent, or like a house you rent for a couple of years in the Florida Keys for $5 million. Well, you deferred $1 million in tax, right? And you can take the other $5 and do something else, whatever you want. You can pay taxes on it or invest in more investment property. Joint ownership problems. Well, this is fairly common when I get people that call that don't want to continue to be partners or be in the same LLC. They're going to want to sell the property. There's a little legal work they have to do before they sell, or preferably before they sell, so that they can either exchange or not. And that's just a partnership split. There's a bunch of different ways you can go about it. However, it has to be, you have to kind of know what you're going to do before you sell the property that you own together. Let's see. Would that work with an exchange from California house to a Texas home? If you're talking about primary residences or even second homes, no. If you're talking about if I'm going to exchange from a California rent house to a Texas rent house, yes. Or anything from California to anything, that's held for investment in terms of real estate could be exchanged, and there's no issues with that. However, you still have that revenue procedure 2000, or I'm sorry, the revenue, you still have the status you have to make on that property in perpetuity, because again, franchise tax board in California is very aggressive about collecting their tax. I hope that answers. I hope I'm answering the right question, but just keep in mind, you cannot exchange a primary residence under any circumstances. Either selling one, exchanging into another one, or selling a primary residence and buying rental property, or selling a rental property and buying into a primary residence. You cannot do it with 1031. All right, estate planning. I get this somewhat frequently. A lot of times it's going to be family businesses like a farm or ranch, and they've got kids. There's 5 kids. They've got a ranch they're going to sell for $100 million. They don't want their kids to be bickering over the next 30 years about who got what. So what they do is they may sell the $100 million ranch and go out and buy 5 $20 million ranches, and then takes the arguing out of their kids. And then when they pass away, the kids each inherit their own ranch, right? 20 million. That's also appealing because when you inherit property, you get a step up in the basis, taxable basis, to the fair market value of the property at the time you inherit it. So there's little to no tax liability in that situation. So let's say your mom and dad pass away, they will you the $100 million ranch, okay? You get a stepped up basis to the fair market value of $100 million. If you turn around and sold it the next day or shortly thereafter without it increasing in value, you'd have no tax liability on the sale, which is pretty neat. I've had a relative do that for me, and it was really, it's a great gift. All right, let's see. When I talk, because I could go on and on. Oh, there we go. Fairly common is diversification. Sell one property, buy multiple. So I sell my let's say, big rent house and or my apartment building, and I go out and buy 5 rent houses or a rent house and another apartment building or an office building and a piece of retail. Very, very commonly done. And it just, people change markets all the time. So it could be for any reason. And you could do that. Or you could also sell several and buy one. So I get a lot of times I'll find people that have accumulated like 30 to 100 rent houses, and they're going to want to combine those in a portfolio, sell it one close, and then just go buy one apartment complex or a commercial, strip center, so that they have less property management concerns, or for whatever reason they just want to do it. Moving markets, you guys are seeing this just like I am. People are moving to Texas from everywhere. California, seeing a lot from Colorado. These folks in these kind of high, historically high value areas are selling their. I had a guy that sold a condo in Aspen and bought a section of land in Oklahoma. So they see that kind of opportunity and they're taking it. Estate planning, kind of went into that already. Sell your ranch and buy 5 mini ranches to give will to your kids so that they get that inherited or that stepped up basis. It's a really good reason to exchange. And this is pretty interesting. So the difference between inheriting property and being gifted property. A lot of times, especially parents want to give their children a house, or they'll want to, give them a business where it has real estate. If they do that, not only are you giving them the property, you're giving them the original basis in the property that you're giving it to, that you're giving. So if you've held a property for 30 years and you're giving it to your kid to carry on the business while you're still alive, they're going to have the full tax liability, which means if they turn around and sold it, they're going to have to pay tax on the entire sale, most likely. Whereas if you passed away and it was in your will to go to your child, they get that step up in basis. So there is no tax liability when they inherit it, if they sell it shortly thereafter. Also, if they've got a fully appreciated, now that they've got a fully stepped up basis in that property, they could start taking the depreciation to offset their income. Let's say they're a higher earner and they just need that. They could certainly do that. Question, Deborah Arnold. If you buy a residential property for investment in an LLC, but live in it while renovating it and then sell it after 2 years, can I do a 1031 exchange for another property to renovate and live in for 2 years? Not if you're living in it. If you, according to the rules, no, right? You would not want to do that. I don't know if people do it. Most of the time people are just going to say, hey, I'm selling this property. I've held it for 2 years. I've rented it to someone. And that's perfectly fine. But if you're living in it while you're renovating it, it's still your primary residence and it doesn't work. I wouldn't advise that or suggest that anybody do that. If you wanted to live in it for 2 years while you're improving it and then rent it out for 2 years, then you can exchange it, or even a year, depending upon your intention. I wouldn't do it in under a year, but yeah, so if you were going to live in it and work on it for 2 years, fine. Don't sell it and think you could do a 1031 on it. Would be not good. LLC is no different. In aggregate, the LLC is if it's you, let's say, or you and your husband, it would be the same as just you. The membership is the same. Will this recording be sent out afterwards? Not sure what you mean. I mean, basically, what you're trying to do doesn't work. I believe you. I've tried to do it for friends and family, and I've thought of really clever ways that you could potentially do this. And every attorney that I've talked to says, no, it won't work. So that's the short answer. The alternative is, if you're going to live in it, build it, live in it, build it, then rent it out, then sell it. The recording and power will be made available. Oh, okay, that's what I thought you were talking about recording the property. Sorry. So yeah, I'm going to be sending this to everybody. Let's see. So those are good questions, and believe me, I get them a lot. Where people are trying to do that, but again, also by living in it and fixing it, you're establishing your intention to resell it more so than having it as an investment or productive use in a trade or business. So not really what you want to do. Okay, here we go. Property held for sale. Property held for sale does not qualify for an exchange. There are a number of factors, including the exchanger's intent at the time of exchange, which gets back to what I was just saying. If you're moving into the property to improve it and then sell it, that establishes your intent. So then you're kind of that's already disqualified it from a 1031 perspective. If you, let's see, frequently the number and extent of real estate transactions entered into an exchange with respect to other properties. Like, so I get flippers calling me every day. Hey, I just finished this property. I want to put it on the market. I'm going to sell it and I want to exchange it. You can't do it. Especially if that's your method of business, it's just another brick that the IRS can use against you in the wall to exchange. So you were asking about the recording of the property. Well, yeah, I mean, whenever you close on a property, it should be recorded. There's never any kind of delay that I'm aware of. So when you move into a property, or when you close on a property, it's going to be recorded. Usually it's going to happen that same day or the day after. Again, it's kind of splitting hairs, and IRS would also potentially look at this as what they call a step transaction, where you're taking additional steps to avoid tax. And they could also disqualify it based on that. So if you're going to play a little audit roulette, we call it, and you want to try it, I'm not the 1031 police. I'll make you aware of the risk, that there's certainly risk there, and that if you are audited and the IRS determines that you aren't eligible, then you're going to pay the taxes that you originally were trying to defer, plus penalties, plus interest. And depending upon how flagrant it is, like I've had some people do some insane things that I've had them sign letters saying that I warned them basically because they were crazy, right? So they were like, oh, hey, I got the property, I'm gonna sell it on Monday for $10 million. I'm gonna buy my replacement property on Friday for 20 million, and I'm gonna turn around and sell it for 60 on the following Monday. Totally out of in the face of 1031. Not only would that be considered outside of the rules, it would be almost considered, well, it could be considered criminal. The 95% exception, can you cover one more time just that one rule? Yes. So when you're talking about the 95% exception, okay, so first we've got the 3 property rule that says I can identify up to 3 properties and they could have a combined value of any amount. So no issue, like I sell for $1 million, I go out and identify 3 properties and they could have a combined value of $1 million, $1 billion, $1 trillion, doesn't matter. Once I identify 4 properties or more, I have the 200% rule. And that says, if I identify more than 3 properties, the combined value can't be more than 200% of my sales price of my relinquished property. So then the 95% exception says, if I identify more than 3 and their combined value is more than 200%, I may be able to rely on the 95% rule, which says if I'm past those 2 rules and I successfully close on 95% or more of what I've identified, then I could be successful at my exchange. You would only rely on that in specific circumstances. The example I gave before was I sell an apartment building, has 1 address, or no, I give a condo, a warehouse. I sell a warehouse that has 1 address, and I go and identify a warehouse complex that's got 5 addresses. But I'm going to close on the whole thing, right? I'm going to sell the warehouse for $1 million. I'm going to go make an offer on the warehouse complex for $5 million. So I'm identifying more than 3 properties, and the combined value is more than twice what I sold my property for. But it's an all or nothing thing. I'm going to close on that entire transaction or nothing at all. and that's how I would rely on the 95% exception. I would never rely on it if I had more than one seller, because chances are one's going to fall out, and then you can't um, you can't rely on that, right? If you sold, let's say if you identified 100 properties and 5 fell out, you would not be able to rely on that. So we have future questions. Yeah, my cell phone number is all over the place. It's on my LinkedIn page. It's on this presentation. I'm also going to send you my standard opening email that has just a ton of information about 1031 exchanges, and it's right there in the first paragraph, but I'll give it to you now. My number is 972-310-4127. And yeah, call anytime. I'm just like you guys. If I'm awake, I'm working. You know, it seems like most questions come in at Sunday night about 8 o'clock or Friday night about 10. I don't know. Might have something to do with cocktails, but that's when people have questions, and I'm usually there to answer them. And it looks like we're finished with our time. I think we're going to be going to breakout room, so I will be seeing some of you there. One last question, I guess, but could you address 1031 with regards to real estate partnership interests? Do these get deferred? CG treatment also if invested into similar partnerships.
Capital gains.
Yeah. So partnership, let's see. Now I'm missing the first part of that question. Hold on. Regards to real estate partnership interests. Well, those are, as long as there's a couple of different ways the partnership sell and buy. One would be the partnership sells and the partnership buys. No problem there, right? Everybody's going together. The partnership is a taxpayer. You get the same capital gain deferral. Now, if you want to split up a partnership, then you've got issues and you've got to hire an attorney because there's what we call about 4 or 5 different methodologies to split a partnership so that the individual members can either exchange or not and defer their capital gain, whether they want, if they want to. I suggest when that's a possibility that people give me a call as far in advance as you can. When I first started doing this 10 years ago, it was pre-contract, right? When now it's more like people are calling me the day before they're supposed to close and saying, "Hey, I've got a partnership split I've got to do, and I'm selling tomorrow. I'm closing tomorrow." That's tough. If they've got 2 weeks or a week, even some cases, I've got attorneys that I could refer them to that can walk them through the different methodologies and choose the one that's best for their particular situation. But it's pretty common that they do have. I mean, it's fairly common. I get calls on it every day. I have an email that I send out. It's got the different methodology. It's also got 3 or 4 different attorney referrals that they can call to get help with that. Now, the timelines for IDing and closing. Yes, I definitely can identify that. So think of a 1031 exchange as having a lifespan of 180 calendar days total from the day of the first closing, whether that be the property that you're selling. In most cases, that's a standard exchange. In the case of a reverse exchange, it's when you're closing on the purchase of the property you're buying. I can go more into reverse in the breakout, but so total of 180 calendar days from the date of the closing. The first 45 days of that is the identification period. So during the first 45 days, we will email our customers a form called a property identification notice. And that form will be used for their identification. They'll follow the 3 property rules while making their identification, and they can email that in prior to midnight on day 45, which will enable them to continue on with the exchange for the remaining 135 days. If they don't make an identification at all, they're going to have a technical termination of their exchange on midnight on day 45. And the exchange is over, and we can release the proceeds to them the following business day. If they do make an identification, however, the exchange remains open until either you've closed on the properties you identified or day 180. So it's important to know that when you're making your identification that you have a realistic chance to close on what you identify, because if you don't close on what you identify, not only are you going to pay the taxes anyway, but the IRS will not allow a qualified intermediary or my company to release the proceeds until the day after the expiration of day 181. So that's something I go to great pains to explain to people because nobody wants to be told they can't get their money. Let's see. Somebody's asking for my number, 972-310-4127. And you probably won't remember my name, but you just put like 1031 guy, and that may be easier to look for. Let's see. I'm trying to go back here.
Patrick, let's go ahead and wrap it up. We'll go take other questions at the breakout room, and I'll turn it over to Parvez to end the current meeting, and then we'll move to breakout rooms.
Sounds good.
Thank you, Patrick, for such a wonderful, informative session and wonderful information. I think now, as Steve said, we're going to break this session here, and we'll move on to the breakout rooms. Steve, how do we group up the breakout rooms and how people can join their breakout room? I think that's going to be important.
So I'll open up the rooms and you can join. You can select your own breakout room. There are going to be 4, one for Patrick, one for office, retail, and professional space, one for industrial and land, and one for hospitality multifamily. So if you have properties or have interest in have clients who are interested in properties in those sectors, please go ahead and join those rooms, or you can join Patrick's room and go into more personal questions there. So I'm going to go ahead and open up the rooms now, and you should see that they're available, and you can select which ones you want to go to. If you have problems, let me know, and I will assign you to a room. And Patrick, I'll go ahead and put you in your breakout room.
Thank you.
Yeah, that'd be a good
Thanks,
idea.
everybody.